A company will have different types of expenditure. How will capital expenditure be treated in the accounts? I'm Thomas Harwood and welcome to the Accounting Student, where we create free and short videos so that you can learn about accounting. Today's video is looking at what is capital expenditure. All businesses have cash coming in, which can be known as income, and cash going out, which can be referred to as expenditure. Expenditure can be defined as a payment or agreement to make a payment, which in return a benefit, asset or service will be received. Expenditure of a business can be a range of anything from paying an electricity bill to the purchase of a new motor vehicle. As there is such a variety of expenditure, it may be useful for a business to categorize them into specific groups, as these will perhaps be treated very differently in the accounts. Expenditure can be distinguished into two main types, and they are known as capital expenditure and revenue expenditure. In this video, we will look at capital expenditure. Capital expenditure is recognizable when a business spends money on fixed assets, additions to a fixed asset, or to get a fixed asset in a position ready to be used. Additionally, capital expenditure can be identified if the money is also spent on transactions or items such as purchasing a fixed asset, bringing a fixed asset into the business, legal costs relating to the purchase of the buildings or property, delivery costs on the machinery or motor vehicles bought, any necessary costs to prepare the fixed asset to be in a condition for use, and finally, interest incurred on the construction of a fixed asset. It is very important to understand that capital expenditure has no relation with the owner's capital account. Capital relates to the owners and the owners only, and capital expenditure relates solely to the business. Also, it is vital that there is a correct distinction between capital and revenue expenditure, as this is essential to determine a correct value for the profit and assets of a business. Let's have a look at an example to demonstrate how we identify capital expenditure. Tina runs an administration company, and when she started the business, an office was bought so that she and other employees could work. This year in February, Tina started to gain more clients and therefore needed more employees to work to cope with demand. As a result, Tina has decided to get an extension on the building the business already has, so that there is more space for more employees to work in. Tina wants to know how to identify what expenditure the extension is in the accounts before she receives the invoices and receipts relating to the extension. The first step would be to see whether the expenditure is directly incurred in bringing the fixed asset into use for the first time. Then it would be a capital expenditure. In this example, the building which the extension is being added to is already in use, so it is not a capital expenditure in this case. If, however, the expenditure improves a fixed asset beyond its capability when first owned, then it can be identified as capital expenditure. As the extension of the building is creating more space for Tina's company and therefore an opportunity for more employees to work, this is improving the building's capability. Therefore, the cost of the extension should be treated as capital expenditure. So that was the explanation of what is capital expenditure. If you enjoyed it, press the like button. If you have a question you want answered, leave it in the comments below and we'll try our best to answer it. And if you're not already subscribed, make sure you click the red subscribe button to keep updated with the Accounting Student. Thanks for watching. We'll see you next time.